On the Ides of March 2023, the global financial system suffered a stroke that was successfully covered up by the most complex technocratic intervention in human history. To the average citizen, that week is remembered as the week Silicon Valley Bank failed and Credit Suisse collapsed. It was presented on the evening news as a series of unfortunate but isolated management errors, a few reckless tech bros in California and some corrupt Swiss bankers getting their comeuppance. But to the historians of money who will write about this era 50 years from now, March 15, 2023 marks the official end of the US dollar as a market-based instrument and its transformation into a purely political tool of state survival. The dollar did not die in the sense that it disappeared from your wallet. It died in the sense that the fundamental rule of capitalism that gave it value, the concept of collateral, was suspended indefinitely to prevent the United States from defaulting on its own insolvency. To understand why this specific date marks the tombstone of the old order, you have to understand the mechanism that broke. For 80 years, the US dollar system was built on a foundation of pristine collateral. This collateral was the US Treasury bond. The entire global banking system operates on a simple premise. If you need cash, you don't beg for it. You pledge a treasury bond as security and borrow against it. This works because everyone agreed that a U.S. Treasury bond was the safest, most liquid, and most accurately priced asset on earth. The price of that bond told you the truth about the value of the dollar and the creditworthiness of the American empire. But throughout 2022, as the Federal Reserve raised interest rates from 0% to 5% to fight inflation, they mathematically destroyed the value of those bonds. A 30-year Treasury bond issued in 2020 at 1.2% interest was trading at 60 or 70 cents on the dollar by March 2023. This is not a theoretical loss, it is a realized hole in the balance sheet of every bank, pension fund, and sovereign nation holding U.S. debt. The banking system was technically insolvent. They owed depositors 100 cents on the dollar, but the assets backing those deposits were worth only 0.7. On March 10, 2023, the market finally woke up to this math when Silicon Valley Bank imploded. The run on the bank began. But it wasn't just a run on SVB, it was a run on the entire U.S. sovereign debt market. If every bank had to sell their treasuries at 70 cents to pay depositors, the entire American banking sector would have been wiped out by Monday morning. The losses would have exceeded the total equity capital of the U.S. financial system. The Federal Reserve faced a binary choice: allow the free market to function, which meant the collapse of the banking system and a Great Depression, or destroy the integrity of the dollar to save the banks. They chose the latter. On Sunday, March 12th, and solidified by the global swap line explosions on March 15th, the Federal Reserve announced the Bank Term Funding Program, BTFP. This acronym sounds boring, but it contained a clause that effectively ended capitalism in the bond market. The Fed declared that they would lend money to banks against their treasury bonds, not at the market value, 0.7, but at par value, 100 cents. Read that again. The Federal Reserve explicitly stated that they would value an asset that the market said was worth $70 as if it were worth 100, simply because they said so. In that instant, price discovery died. The value of the U.S. dollar was no longer determined by what the world was willing to pay for U.S. assets. It was determined by an arbitrary decree from the central bank. They effectively created $30 of value out of thin air for every $100 of collateral. It was a retroactive bailout of the entire bond market hidden in the plumbing of a lending facility. Why is March 15th the critical date? Because that is when the contagion crossed the Atlantic and broke the neutral ledger of the world, Credit Suisse. While the BTFP stopped the bleeding in American regional banks, the global margin call had already been triggered offshore. Credit Suisse was the weakest link in the euro-dollar chain. It was systemically important. On March 15th, its largest shareholder, the Saudi National Bank, announced they would provide no further assistance. The stock crashed. The panic that ensued was not about a Swiss bank's bad management. It was about the realization that the euro-dollar system, the network of offshore dollars, was out of collateral. The Swiss National Bank, SNB, panicked by the prospect of a total collapse, had to invoke a liquidity backstop. But where did the SNB get the dollars to bail out Credit Suisse? They can print francs, but they cannot print dollars. They got them from the Federal Reserve via swap lines. On that day, the U.S. Federal Reserve effectively became the central bank of Switzerland. They flooded the global system with dollars to paper over the fact that the collateral underneath the system was rotten. This created a terrifying realization for the global South, specifically China, Saudi Arabia, and Iran. They watched the BTFP and the Credit Suisse bailout and realized the game was rigged. If you are a foreign nation holding U.S. Treasury bonds, you do not have access to the BTFP. If China wants to sell its treasuries, it has to sell them at the market price, 70 cents. But if a U.S. bank holds the same bond, they can swap it with the Fed for 100 cents. The United States created a two-tier monetary system. Tier 1, U.S. banks and close allies who get swap lines, who are protected from the consequences of bad investment decisions. Tier 2, everyone else who must eat the losses of the Fed's inflation. This was the moment the petrodollar agreement was spiritually ripped up. It is no coincidence that in the exact same week of March 2023, the headlines were dominated by the unprecedented diplomatic breakthrough between Saudi Arabia and Iran, brokered by China. While the West was frantically gluing its broken banking system back together with fake valuations, the East was building a new energy architecture. They realized that holding U.S. debt was no longer a store of value because the U.S. government had proven it would change the rules of valuation whenever its own banks were in trouble. The risk-free rate had become the return-free risk. The nobody-noticed part of this story is the most insidious because the Fed didn't call it quantitative easing, QE. The inflation alarms didn't go off immediately. They called it a liquidity injection. They said it was a loan, not a grant, but the mechanic was identical to printing money. By allowing banks to monetize their losses at par, the Fed effectively injected hundreds of billions of dollars of phantom capital into the system. This is why the stock market, particularly the tech sector in AI stocks, ripped higher in 2023 and 2024. Despite the economy slowing down, the market sniffed out the liquidity. Smart investors realized that if the Fed was willing to backstop the bond market at par, then nothing would be allowed to fail. The Fed put was back, but this time it wasn't just for stocks, it was for the very foundation of the ledger. The BTFP proved that the U.S. government will always choose inflation over default. They will always choose to debase the currency rather than allow the assets of the wealthy to mark to market. This realization broke the psychological anchor of the dollar. Before March 15, 2023, you could argue that the Fed was serious about fighting inflation, that Paul Volcker was their hero. After March 15, 2023, it became clear that they are not Volcker. They are the Weimar Reichsbank in a better suit. They saved the banks, but they sacrificed the trust that makes a fiat currency viable long-term. The death was not a sudden heart attack. It was the diagnosis of a terminal cancer. The patient is walking around spending money and looking normal, but the cells inside the collateral chains that bind the global economy have started to undergo a malignant transformation that cannot be reversed without a total reset of the system. The immediate aftermath of the Bank Term Funding Program, BTFP, was not a restoration of confidence, but a quiet, terrifying confirmation among the world's most sophisticated capital allocators that the United States had effectively nationalized its bond market. By agreeing to value distressed assets at par, the Federal Reserve introduced a fatal distortion into the machinery of global capitalism. In a functioning free market, failure is the mechanism that clears the system of bad debt and incompetence. If a bank mismanages its duration risk, buying long-term bonds right before rates skyrocket, it is supposed to fail. Its assets are supposed to be liquidated at market prices. The prudent banks buy them for pennies on the dollar. This creative destruction ensures that capital flows from the foolish to the wise. But on March 15, 2023, the Fed announced that there would be no destruction, creative or otherwise. They effectively told the banking sector, heads you win, tails the taxpayer prints the difference. This destroyed the concept of counterparty risk within the U.S. domestic system, but it drastically escalated it for everyone outside the system. To a central banker in Beijing, Brasilia, or Mumbai, the message was unmistakable. The U.S. dollar is no longer a neutral store of value. It is a political weapon that will be debased to protect American institutions at the expense of foreign holders. If the Fed prints $1 trillion to backstop the BTFP, That inflation is exported. The purchasing power of the treasury bonds held by the People's Bank of China is diluted to save a regional bank in California. This is taxation without representation on a geopolitical scale. The foreign creditors are paying for the bailouts of the American debtors through the invisible tax of currency devaluation. This realization sparked the great remonetization of gold. For 50 years, Western financial theory taught that gold was a barbarous relic. It yielded nothing, it was heavy, it was archaic. The sophisticated asset was the U.S. Treasury bond, which paid interest and was backed by the full faith and credit of the superpower. But after March 2023, the equation flipped. If the full faith and credit means we will change the accounting rules when we are losing, then the credit is worthless. Central banks began to look for an asset that had no counterparty risk, an asset that is not a liability of another nation, an asset that cannot be printed by a panic-stricken committee in Washington. That asset is gold. In the months following the banking crisis, we witnessed the most aggressive central bank gold buying spree since 1967, the collapse of the London gold pool. China did not just buy gold, they vacuumed it out of the London and Swiss vaults. Singapore, Poland, India, and Turkey followed suit. They were not buying paper gold futures contracts or ETFs. They were buying physical bars and repatriating them. They were taking delivery. This is the behavior of a creditor who knows the debtor is about to default. They are cashing in their chips, treasuries, and taking the poker table gold home with them. This shift marks the end of the petrodollar era and the beginning of the petro-golds or commodity currency era. The old deal, Saudi Arabia sells oil for dollars and buys U.S. treasuries, relied on the treasuries being good as gold. Now that the treasuries are good as 70 cents on the dollar, unless you're an American bank, the deal is broken. We are seeing the rise of settlement fragmentation. Oil is now being traded in yuan, it is being traded in dirhams, it is being traded in rupees. But these currencies are just intermediate vehicles. Nobody wants to hold rupees for 30 years. The ultimate settlement asset for these trades is increasingly gold. China is effectively saying to Saudi Arabia, accept our yuan for your oil, and you can immediately convert that yuan into physical gold on the Shanghai Gold Exchange. This bypasses the US dollar entirely. It creates a closed loop. Oil, yuan, gold. The U.S. military can control the sea lanes, but the Fed cannot control this trade settlement. By weaponizing the dollar system via sanctions and debasing the dollar system via the BTFP, the U.S. has incentivized the creation of a parallel financial plumbing that is immune to its leverage. Furthermore, the domestic implications of the BTFP are just as cancerous. The facility created a zombie banking system. Hundreds of U.S. banks are technically insolvent. They are walking dead. Their loan books are filled with commercial real estate loans that will never be repaid and treasury bonds that are underwater. But because they have access to the Fed's lifeline, they do not close their doors. Instead, they exist in a state of suspended animation. They stopped lending to the real economy. They cannot take risks because they have no equity cushion. They become hoarders of capital rather than allocators of capital. This is exactly what happened to Japan in the 1990s. The lost decade was caused by the refusal to let insolvent banks fail. The U.S. has now Japaneseified its entire financial sector. Small businesses, the engine of the American economy, are finding it impossible to get loans because the local banks are paralyzed by their hidden insolvency. The credit crunch we are seeing in 2024, 2025, and 2026 is the direct result of the fake stability purchased in March 2023. The Fed saved the banks, but they sacrificed the economy. This zombie status drives the phenomenon of deposit flight. Smart depositors, corporate treasurers, and family offices know the banks are zombies. They know that the FDIC insurance limit of $250,000 is a joke in a hyperinflationary environment. So money is fleeing the banking system and moving into money market funds. These funds invest directly in short-term government debt or reverse repos. This drains liquidity from the commercial banks, forcing them to rely even more on the Fed's emergency facilities. It creates a vicious loop. 1. Banks are weak. 2. Depositors leave. 3. Banks get weaker. 4. Fed prints more to support them. 5. Inflation rises. 6. Depositors leave faster to chase higher yields. The end game of this loop is the nationalization of the deposit base. Eventually, the private banking model becomes unsustainable. The government effectively guarantees all deposits, as they hinted they would in 2023, which means the government controls the allocation of all credit. If the government guarantees the liabilities, they will eventually demand control of the assets. This leads to a world where credit is not determined by profit, but by political alignment, ESG, industrial policy, etc. The death of the dollar as a market instrument leads inevitably to the birth of the dollar as a tool of total state control. The central bank digital currency, CBDC. The CBDC is the only technological solution to a banking system that can no longer survive on market principles. If the banks are zombies, the Fed must become the bank of everyone. March 15, 2023 was the moment the mask slipped. It revealed that the free market is a myth that is only allowed to exist when prices are going up. When prices go down, the market is suspended. The J rules-based international order is only rules-based when the rules favor the issuer of the reserve currency. When the rules become inconvenient, they are rewritten overnight. The world saw this. The billionaires moving to Dubai saw this. The central bankers in the global south saw this. They are all positioning themselves for the post-dollar world. They are not declaring war on the dollar. They are simply exiting the theater. They are building lifeboats. They are buying gold. They are buying Bitcoin. They are buying farmland. They are converting the political liability, or dollars, into political neutrality. Hard assets. The tragedy is that the average American saver, whose pension and life savings are denominated in these political liabilities, has no idea that the foundation of their wealth was liquidated 3 years ago. They are still counting their paper, unaware that the game has changed from who has the most dollars to who has the most collateral. The death of a reserve currency is almost never a singular explosive event like a supernova. It is a long, agonizing process of rotting from the inside out, similar to a termite infestation in a seemingly solid house. On the surface, the paint looks fresh, the walls stand tall and the roof holds against the rain. But inside the load-bearing beams, the structural integrity has been eaten away. The homeowner continues to live in the house, sleeping in the bedroom and cooking in the kitchen, completely unaware that the safety factor has dropped to zero. This is the condition of the American middle class today. They look at their 40.1K balances, their home equity, and their checking accounts, and they see numbers that look reassuringly high. They do not realize that these numbers are denominated in a measurement unit, the post-2023 dollar, that has been fundamentally compromised. The wealth they think they possess is a nominal illusion that is being sustained only by the accelerating debasement of the currency itself. This creates the most dangerous economic environment in history, the inflationary melt-up. Most people prepare for a crash. They hold cash waiting for the S&P 500 to drop 50% so they can buy the dip. But in a sovereign debt crisis, the market often does not crash in nominal terms. It crashes in real terms while rising in nominal terms. Look at the stock market of Weimar Germany in 1923, or Zimbabwe in 2008, or Venezuela in 2016. In local currency terms, these stock markets were the best performing assets in the world. They went up 1,000%, 10,000%, 1,000,000%. Did the investors get rich? No, they got wiped out, because while the stock market went up 10,000%, the cost of bread went up 20,000%. The rise in asset prices was just a reflection of the collapse of the currency. The U.S. is entering the early stages of this dynamic. When the Fed signaled with the BTFP that it would print to save the bond market, the stock market rallied. It wasn't rallying because companies were selling more widgets. It was rallying because the market realized the dollar was being diluted. If you own Apple stock, you own a slice of a real company with real cash flow. If the dollar loses 20% of its value, the price of Apple stock should theoretically rise 20%, just to stay consistent. The stock market has become an inflation hedge rather than a growth engine. The tragedy is that the average person sees the Dow Jones hitting all-time highs and thinks the economy is doing great. They are celebrating the devaluation of their own labor. This brings us to the silent default. The U.S. government has $36 trillion in debt and over $200 trillion in unfunded liabilities, Social Security, Medicare. There is mathematically no way to pay this back in honest money. They have two choices. 1. Honest default. Tell the bondholders and pensioners, sorry, we're broke, you get 50 cents on the dollar. Political suicide. 2. Dishonest default. Inflation. Print the money to pay the bills in full, but ensure that the money buys half as much. Political survival. They have chosen option 2. The death of the dollar on March 15, 2023 was the moment they committed to this path. By backstopping the system at par, they guaranteed that the money supply would always expand to meet the debt obligations. This means that for the next decade, your savings are under attack. You're being targeted by financial repression. The interest rate you earn in your bank account will be 4%, but the true rate of inflation, including housing, food, and insurance, will be 8% or 10%. You are losing 4 to 6% of your purchasing power every single year. It is a slow-motion confiscation of wealth that is invisible to the uneducated. The government is stealing your retirement, not by taxing it, but by diluting it. So, how do you survive in a house that is being eaten by termites? You have to stop storing your wealth in the wood, fiat currency, and bonds, and start storing it in the steel, hard assets. The traditional 60-40 portfolio, 60% stocks, 40% bonds, is a death trap in this environment. The 40% allocated to bonds is effectively dead money. It is a guaranteed real loss. The bond market has transformed from a safe haven into a certificate of confiscation. The new portfolio must be a barbell strategy. On one end of the barbell, you hold short-term liquidity, T-bills or money market funds. You need cash to pay bills and buy groceries, but you keep the duration short, under 6 months, so you're not trapped in long-term devaluation. On the other end of the barbell, you hold zero counterparty assets. This means gold, silver, Bitcoin, and productive land. These are the assets that the Fed cannot print. When the dollar is debased, these assets reprice higher. They are the lifeboats. Notice that none of these assets have a CEO, none of them have an earnings report, none of them rely on a government promise. They derive their value from physics, gold, land, or mathematics, Bitcoin. In a world where political promises are worthless, physics and math are the only things you can trust. However, the most critical adjustment is psychological. You must abandon the money illusion. Stop measuring your wealth in dollars. If your house goes up in value from $500,000 to $600,000, you feel $100,000 richer. But if a loaf of bread goes from $4 to $6 and a new car goes from $30,000 to $45,000, are you actually richer? No. You're just holding more units of a dying currency. Start measuring your wealth in ounces of gold or Bitcoin. Priced in gold, the U.S. stock market has been flat or down for the last 20 years. Priced in gold, the average American wage has collapsed since 1971. When you change the denominator to something honest, the illusion of prosperity vanishes and the reality of the decline becomes clear. This clarity is painful, but it is necessary. It forces you to stop chasing yield, risky bets to make 10%, and start chasing preservation, owning things that cannot be diluted. The events of March 2013 were a warning shot. The system cracked, and they patched it with duct tape and money printing. They bought time, but they did not fix the structural problem. Too much debt, not enough collateral. The next crisis will be bigger than SVB. It will be bigger than Credit Suisse. It will likely involve a sovereign entity or a GSIB, global systemically important bank. And when that happens, the Fed will not just print billions, they will print trillions. They will implement yield curve control, YCC, capping rates to prevent the government from going bankrupt. That is the endgame. When YCC arrives, the dollar enters its final phase of rapid devaluation. The death that happened in 2023 will become a funeral in 2026 or 27. The people who are prepared, the ones who hold the steel, will survive the collapse of the house. The ones who are still trusting the wood, the ones holding cash, bonds, and annuities, will find themselves standing in the rubble, wondering where their life savings went, even though the statement still says they have $1 million. The dollar didn't die with a bang. It died with a bailout. And now you know the truth.